Welcome back to our channel, where we will be diving deep into the terminologies that are essential to help you get ready for your financial certification exams like investment funds and Canadian securities. Whether you're gearing up to tackle your exams head-on or just looking to boost your financial vocabulary, you're in the right place. Don't forget to hit that subscribe button and ring the notification bell, so you never miss an update from us. As always, remember to like, comment, and share your thoughts. Now, let's begin. Face value. The face value of a bond or debenture is the nominal value that is printed on the face of the certificate. It represents the amount that the issuer is obligated to repay to the bondholder at the bond's maturity date. However, it's important to note that the face value does not necessarily reflect the bond's current market value, which can fluctuate based on various factors such as interest rates, credit quality, and market conditions. Investors may buy or sell bonds at prices above or below their face value in the secondary market, which can result in yields that differ from the stated coupon rate. F-Class Fund. An F-Class fund is a type of mutual fund designed for fee-based financial advisors and investors. It stands for fee-based or fee-only class, and it typically features a lower management expense ratio, MER, compared to other fund classes. F-Class funds are structured to eliminate or reduce embedded commissions, which can help investors lower their overall investment costs. These funds are well suited for fee-based financial advisors who charge clients directly for their services rather than earning commissions from the sale of investment products. Fee-based accounts. Fee-based accounts are a type of financial account offered by investment advisors or financial institutions. These accounts combine various financial services, such as investment management, financial planning, and advisory services, into a single fee structure. The fee is typically calculated as a percentage of the client's assets under management, AUM, often ranging from 1% to 3% annually. Fiduciary responsibility. Fiduciary responsibility refers to the ethical and legal obligation of a financial professional, such as an investment advisor, mutual fund salesperson, or financial planner, to always prioritize and act in the best interests of their clients. In this role, the fiduciary must adhere to a high standard of trust, loyalty, and care when providing advice or managing a client's assets. Final good. A final good is a finished product that is ultimately purchased and consumed by the end user, as opposed to being used as an intermediate input in the production of another good. It represents the end of the production process, and is intended for direct consumption or use by individuals or households. Final goods are the tangible or intangible products that fulfill the needs and desires of consumers, such as consumer goods. These goods are contrasted with intermediate goods, which are used in the production of other goods and do not reach the end consumer in their current form. Final prospectus. A final prospectus is an important document when companies want to sell new stocks or bonds. It's like the official guidebook for investors. It replaces an earlier document called the preliminary prospectus and gets approval from government authorities in Canada. This final prospectus has all the important details about the company, what they're selling, and the rules for those investments. When someone buys these investments for the first time, they get a copy of this document. It's a way to make sure investors have all facts they need to make smart choices and to make sure things are fair and clear. Financial asset. A financial asset is something you own that doesn't have a physical form, like money or a house. It's more like a piece of paper or a digital record that represents something valuable. For instance, stocks, which represent ownership in a company, or bonds, which are like IOUs from a borrower, are financial assets. Even the money you have in a bank account is considered a financial asset because it's a claim you have on the bank for that amount. These financial assets represent your rights to future benefits or payments. Financial futures. Financial futures are contracts linked to financial assets like currencies or stock indexes. These contracts help investors manage risk or make bets on future price changes. For example, Currency futures can protect against exchange rate swings, while stock index futures allow speculating on market movements. Financial futures are essential tools for managing risk and discovering prices in financial markets. Financial intermediary. A financial intermediary is an institution like a bank, insurance company, credit union, or mutual fund that takes in money from investors and then puts that money to work by making investments. These intermediaries act as middlemen, connecting people who have money to invest with opportunities to earn a return on that money, such as loans or investments in stocks and bonds. They play a crucial role in the financial system by efficiently channeling funds from savers to borrowers or investors. Financial ratios. Financial ratios are calculations based on a company's financial statements that offer insights into its financial well-being. These ratios use data from financial reports like the income statement and balance sheet to assess various aspects of a company's performance, including profitability, liquidity, solvency, and efficiency. They help analysts and investors evaluate a company's financial health and make informed decisions about investing or lending. Common financial ratios include the debt-to-equity ratio, earnings per share, EPS, and the current ratio, among others. These ratios provide valuable information for assessing a company's financial stability and performance. Financial risk. Financial risk refers to the extra level of risk that shareholders face when a company chooses to use debt as a means to fund its activities. Interest payments and repayment of the borrowed money can increase the financial pressure on the company, especially if it encounters financial difficulties. This heightened financial obligation can impact the returns and financial stability of common shareholders. Essentially, financial risk arises from the potential for debt-related challenges to affect a company's ability to generate returns for its equity shareholders. Financing. Financing refers to the process of purchasing a security issue from a corporation by one or more investment dealers with the intention of reselling those securities to investors. It involves a formal agreement between the investment dealer and the issuing corporation, which is known as the underwriting agreement. Essentially, financing is synonymous with underwriting, as it describes the role of investment dealers in helping companies raise capital by buying and selling their securities. Financing group. A financing group refers to the lead underwriter or managing underwriter responsible for overseeing and managing a new securities issuance brought to the market by an issuing company. These underwriters play a crucial role in the process of bringing new securities to investors. The financing group is responsible for pricing the securities, marketing the offering to potential investors, and ensuring that the issuance complies with regulatory requirements. Essentially, they take the lead in helping the issuing company raise capital through the sale of securities in the financial markets. Fintech. Fintech, short for financial technology, refers to companies that leverage computer technology to offer more efficient and innovative financial products and services. These firms use technology to streamline financial processes, improve accessibility, and create new financial solutions, often challenging traditional financial institutions. Fintech covers a wide range of areas, including online banking, digital payments, peer-to-peer lending, robo-advisors, and blockchain-based solutions. Firewall. Policies implemented to separate and isolate persons within a firm who make investment decisions from persons within a firm who are privy to undisclosed material information which may influence those decisions. For example, there should be separate fax machines for research departments and sales departments. Firm commitment underwriting. Firm commitment underwriting is an agreement where the underwriter commits to purchasing a specific quantity of securities from an issuer at a predetermined price. The underwriter then takes on the responsibility of selling these securities to the public. In this arrangement, the underwriter pays the full proceeds of the sale to the issuer upfront, regardless of whether they are successful in reselling the securities to investors. Essentially, the underwriter bears the risk of selling the securities and must do so, even if market conditions are unfavorable. Fixed income arbitrage strategy. In simpler terms, Fixed income arbitrage involves finding opportunities where bonds or related financial products are mispriced in the market, and then making trades to capture the potential profits when these prices adjust to their correct levels. This strategy requires a deep understanding of fixed income markets and the ability to identify and execute trades swiftly to exploit these price discrepancies. Fixed income securities. Fixed income securities are investments that provide a predictable and regular stream of interest or dividend income. Examples of fixed income securities include bonds, debentures, and preferred shares. These investments are known for offering a set payment schedule, often in the form of periodic interest payments, to their holders. In simpler terms, when you invest in fixed income securities like bonds, you receive a consistent flow of income in the form of interest or dividends over a specified period. Fixed period withdrawal plan. A fixed period withdrawal plan is a financial arrangement where a predetermined amount of money is withdrawn from an investment over a specified period of time. The goal of this plan is to use up all of the invested capital by the end of the predetermined period. This means that investors aim to withdraw a consistent amount regularly until they've depleted their entire investment. In simpler terms, it's like setting a financial plan to gradually use up your investment over a specific time frame by withdrawing a set amount regularly until it's all gone. Flat. When a bond or debenture is described as flat, it means that the quoted market price of the security includes its total cost, and it does not involve any accrued interest transactions. In other words, the price reflects the full amount that an investor would need to pay to purchase the bond or debenture, without any additional interest payments. This term is often used when referring to bonds or debentures that are in default of interest payments. In such cases, the securities are typically sold at a price that includes both the principal amount and any past due interest, and this combined price is considered flat. It's important to note that flat pricing simplifies transactions involving defaulted securities by including all outstanding amounts in a single price. Float. Float, also known as public float, refers to the portion of a company's issued shares that are actively available for trading in the public financial markets. These shares are not held by company insiders, such as officers, directors, or major shareholders who have a controlling interest in the company. Instead, they are in the hands of individual and institutional investors, allowing them to be bought and sold on public stock exchanges. Floating exchange rate. A floating exchange rate is a system in which a country's currency value is primarily determined by market forces of supply and demand. Under this system, a country's central bank typically does not fix or peg its currency to a specific value but instead allows market dynamics to influence its exchange rate. However, central banks may intervene in the foreign exchange market if they believe that the currency's movements are excessive or disorderly. As we wrap up this session, we're thrilled to have embarked on this journey together, exploring the foundational terminologies crucial for acing your financial certification exams, including investment funds and Canadian securities. If you found our insights valuable, remember to show your support with a thumbs up and extend the knowledge to your fellow learners. We trust that these insights will prove indispensable on your road to success. Stay tuned for more enriching content, and remember, your financial expertise is just a click away.